Jeni Browne. Welcome to this week's MFB News. Hope everything's good with you. You've had a fantastic week, lovely weekend, and you're getting out in this beautiful sunshine when it's there. I'm sure winter will be upon us before we know it. God, I'm full of joy today. On the subject of joy, it's election week. We're not going to talk about the election today. I think we've done that one to death, but obviously we'll try and come back to that next week and talk a bit about that and how that's landed. So what we are going to be covering off this week is our usual rundown on lender pricing changes. We're going to talk about house prices. There's been some surprising, maybe surprising for some, news there. And then we're going to chat a bit about inflation as well, just to kind of give you an idea about what's going on, particularly in the retail sector. Okay, so first up, swap rates. And the good news is that swap rates haven't changed really in the last weeks. They're still pretty much on par with where they are last week. The bad news is that swap rates haven't changed much since last week, so they're still the same. So no real movement there. And actually in a time where we're in for a bit of uncertainty, particularly with the election, I suspect that actually swap rates not moving around too much is a good thing. Let's see how they react after the election goes through, but I don't expect anything major to change given the fairly kind of concrete view of the market and the UK more broadly in terms of who's going to be in power come Friday. So the fallout is that because the swap rates haven't really changed, we have seen some lenders repricing, but nothing too major. But to give you a flavour on what's going on, and the good news is that the pricing changes we have seen have been on a downwards trajectory. So there you go, some good news. So first of all, Aldermore have repriced and also issued some new limited edition rates. So they're 5-year fixed rates for standard applications, so normal mortgage applications for people and limited companies are now from 4.99, and their multi-property rates are from 4.89% on 5-year money. Now, in terms of a multi-property application, this is where you have one single mortgage application, but there are multiple properties mortgaged within that. And we talk about these often. The good news is that when you apply for one of these mortgages, it's one single loan account, which means that the administration of the mortgage is very, very seamless because you're just managing one mortgage payment. Another good thing can be that if you've got a portfolio that you're looking to refinance where some properties wash their face in terms of rental calculations and others do not, because the lender's lending across the whole thing, they use the rent in aggregate, i.e. the total of it. Therefore, that can kind of ameliorate any, God, I'm sorry, the dictionary today, haven't I? Smooth out any shortfalls in rental income by leaning on the ones which have lots of rent coming through. The downside of having a multi-property mortgage, I was going to say the word portfolio loan because that's what they have been referred to in previous times. It's a bit of marketing jargon, makes it sound very exciting, a portfolio loan. The downside of one of these is that if you were to sell one of the properties, and let's say you initially took the mortgage at 75% loan to value and you're selling one of the properties for £100,000, you would expect to be able to say to the lender, well, okay, I borrowed 75%, so I'm going to give you back 75% of the £100,000, but the other £25,000 I'm going to take back for me and, you know, invest in another property or go on a cruise, whatever it is you want to do with it. But it doesn't actually necessarily work that way. So the lender may let you have all of the £25,000 back, but actually contractually they're not obliged to do so. So in terms of how much of that capital you'd actually realise, it would remain to be seen and would only be determined at the point of you wanting to do it. So that can give some people the heebie-jeebies and not want to take a portfolio loan. So there you go, a very, very long way of explaining what's been happening with Aldermore. Specialist lender, so HMOs, multi-units, limited companies, they can be trading companies, which isn't the norm actually amongst the lenders, layered companies and lots of really good stuff like that. So good to see them bringing out some competitive rates. Now we've seen Capital Home Loans that also released some new limited edition products. Their 2-year fixed rates here are from 3.95 and 5 years from 4.99. CHL specialist lender. So as you would imagine, when I'm saying 2-year fixed from 3.95, they're going to carry some pretty hefty arrangement fees. Accord mortgages have made reductions of between up to 0.05% and 0.4%. The Leeds have reduced their limited company rates by up to 0.15%. NatWest have reduced rates by up to 0.18%. And the Coventry have also dropped some of their rates down as well. So I think what we can take from this is that there is some repricing carrying on downwards. It's not massive, you know, 0.15, 0.18. This isn't life-changing stuff, but it is a step in the right direction. And because the swap rates haven't actually moved downwards, it's not like the lender's cost of funds has changed week on week. So what this really tells me that because we're in a more settled period in terms of swap rates staying fairly static, the lenders are able to kind of exercise a reduction in pricing because they're not worried about things kind of shooting back up again, which I guess really is a nod to the stability that they see kind of being in place over the coming few weeks and months. The Nationwide have released some house price data which I wanted to share with you, and the headline here is that UK house prices rose by 0.2% month on month in June this year. So the average house price now, according to the Nationwide Building Society, is £266,604. And this increased the annual growth rate from 1.3% in May to 1.5% in June. So essentially houses are now 1.5% more expensive in June this year compared to June of the previous year. Now, just to compare this to where we have been, in summer 2022, there was a record high in terms of house prices. We're still currently 3% below that. So it's not like we've kind of recovered in the market, but things are definitely moving in the right direction. I think that could be quite an important message for those of you who are thinking about investing but waiting to see with house prices. Now, I will come on to the more granular detail in terms of regional performance in a moment, because this is important, because this is the average house price increase rather than taking it down to a more granular level. Now, just to note that despite the increase in house prices, the housing market activity has remained relatively flat over the past year, with the total number of transactions down approximately 15% compared to 2019 levels, with mortgage-involved transactions dropping nearly 25% due to higher borrowing costs. Cash transactions are up about 5% from pre-pandemic levels. Now, interestingly, the latest Nationwide House Price Index showed that while earnings growth has outpaced house price growth in recent years, this has not offset the impact of higher mortgage rates, which remain well above the record lows of 2021. So to give an example, today, a borrower earning the average UK income buying a typical first-time buyer property with a 20% deposit would have to pay a monthly mortgage payment equivalent to 37% of their take-home pay, well above the long-run average of 30%. So despite salaries increasing and house prices maybe being very flat or coming down, actually because of the additional mortgage costs, the percentage that people are spending of their take-home pay on mortgages has still increased significantly. Now, moving on to the more regional levels. So meanwhile, the regional house price indices for the second quarter of 2024 showed a mixed picture. So Northern Ireland was the best performing area, with prices up 4.1% compared to quarter 2 2023. In England, overall prices increased by 0.6%, while Wales and Scotland both saw a 1.4% year-on-year rise. Northern England, including the North West, the North, Yorkshire and the Humber, East Midlands and West Midlands, outperformed Southern England with a 2.4% year-on-year increase. So these areas have performed particularly well. In contrast, Southern England, comprising of South West, Outer South East, Outer Metropolitan, London and East Anglia, saw a 0.3% year-on-year fall, the same as the previous quarter. London was the best performing southern region with an annual house price growth of 1.6%, whilst East Anglia was the weakest with prices down 1.8% year-on-year. So as you can see, it's quite a mixed picture in terms of how various regions are performing. We always knew that the south of England would find things tougher because we're more exposed to the higher mortgage costs, because the house prices down here tend to be more expensive, which means that borrowers need to borrow more money to acquire them. So we were always going to find the, broadly speaking, the increased cost in mortgage prices probably more impactful to the property market. However, as it looks, London is actually kind of bucking the trend on that, which is definitely interesting. Okay, now just to touch on inflation, or specifically inflation in relation to retail prices. So retailers have been slashing prices on TVs to capitalise on the Euros, and this has helped push shop price inflation to its lowest level since October 2021. So according to the British Retail Consortium and Nielsen, prices in the retail sector increased by just 0.2% in the year to June, down from 0.6% in May. This was lower than many economists had expected. Non-food prices actually fell 1% in the year to June, so non-food prices have actually gone down, down from a 0.8% fall in May. Now, Dickinson, who is the chief executive of the British Retail Consortium, noted that retailers had slashed prices on TVs to attract football fans during the Euros, which partly explains the annual fall. However, the figures also showed that annual food inflation decelerated to 2.5% in June, which is its lowest level since December 21, and this was the 14th consecutive deceleration in food prices. So essentially the rate at which food prices are increasing has slowed right down to its lowest level in many years. Now, Dickinson said that inflationary pressures had eased after firms had taken steps to ensure they were less exposed to supply chain disruption. So during the height of the cost of living crisis, retailers invested heavily in improving their operations and supply chains to compensate for the impact of global shocks on input costs. Now, this is clearly paying off, with shop prices having risen just 0.2% over the past 12 months. Food inflation is now lower than any time since 2021, and this is helped by the falling prices of key products such as butter and coffee. Hooray for that, two of my favourite products. Now, with uncertainty around discretionary spending, we expect intense competition across the marketplace to keep price increases as low as possible this summer. So that really is just telling me that we're not expecting kind of things to suddenly increase. Actually, it's going to be fierce competition amongst retailers to try and keep the cost down and keep people shopping in their stores and spending their money. Now, the kind of reason this is important to you, I think, is kind of the sort of sucker punch with all of this. The news will reassure policymakers at the Bank of England that the cost pressures are easing as they consider when to cut interest rates. So this is essentially all building up to the fact this is good news in terms of where things are headed, and will provide reassurance to the policymakers at the MPC in terms of what they should do when they meet up again in August to determine whether they should be dropping base rate down or not. Headline inflation fell to 2% in May, which we know is lowest level since July 21. However, the Bank of England kept interest rates on hold last month due to fears about stubborn price pressures in the services sector. So obviously what we've done is we've talked about the retail prices here. And as we talked about in previous weeks, services are actually still seeing quite a high levels of inflation, so around 6%. And also wage growth is still sitting at around 6% as well. So the MPC's job is to kind of balance all of these things. In terms of predictions for a base rate reduction in August, it's still very much 50-50 at the moment, but obviously we'll keep you posted as we run up to that. And that's us for this week. So we will be catching up with you same time again next week, quite possibly, quite probably, with a new government in play. And we'll be hoping to discuss a bit more about that, how it's impacting things. But in the meantime, if you do have any questions, we'd love to hear from you. 0345 345 6788, or have a look at our website. In terms of expectations on pricing over the next few weeks, I generally can't see much changing at the moment, unless something kind of major happens. So I do suspect actually for the next few weeks at least, if you are thinking, or are you in a position, I mean, at the moment most people are only really taking mortgages if they need to, so they've found something they really want to buy, or if they need to remortgage because their rate is literally about to end. But beyond that, most people are kind of just watching and waiting for the time being, which is perfectly understandable. So for those of you in a position where you do need to kind of act a little bit faster, I genuinely think that for the time being, we're not going to see much happening. You might see lenders, playing around, tinkering, I think is probably the best way of explaining it. Their interest rates shaving off, 0.05 here and 0.01 there, but no major changes will happen until probably into the early autumn now. Have a good week, and I'll see you again same time next week.